Assalamu alaikum. First of all, many people would like to have that doctor title there, but unfortunately I don't have it yet, so it's a little bit redundant. Thank you for hosting this. We should definitely thank Mr. Savaş Alpay for organizing this. It is an important area that has been looked in more eagerly way, especially not just in the Muslim countries, but also in the West. We were a couple of years ago in Czech Republic, and given the problems that they face in the EU, Czech Republic is a kind of in a better shape. But given the problems that their neighbors face, they were kind of looking into alternative financing methodologies, and that's why we were there in a meeting organized by the Central Bank of the Czech Republic to tell them about Islamic finance. Now, what I will do is I will delve a little bit more into the risks facing participation banks, participatory finance, and open up a little bit of what Mr. Al-Khariji explained, and the impact of that on the regulatory and the macroeconomic policymakers. I would like to talk a little bit more in the general terms. Now, all banks face credit risks, liquidity risk, and the risks that were mentioned by Mr. Al-Khariji. Now, when the regulators look at Islamic banks, in most environments, they kind of look at it at the same way as they look at conventional banks and regulate them and put the rules in very much the same fashion as they put the rules for conventional banks. Obviously, we do face the same risks as credit risk and liquidity risk, but the problem is not, although we face the same risks, we do not reflect them, we do not respond to them in the same way. Take the example of credit risk, for example. A credit risk is a risk when you give a credit to a customer. This could be by direct lending in conventional banks, but in Islamic banks, in participation banks, this is through a real transaction-based financing. So in Turkey, for example, around 80 to 90% of the credit portfolio is murabaha, which is the financing of real transactions. There has to be an asset that is being transacted from a seller to a buyer, which the participation bank has to finance. Now, this means that you look into the kind of credit that you're giving into. You're looking into the customer who's borrowing that. You're looking into what he's going to be using that for, which was actually one of the issues that was talked in the previous session. I think that is one important issue in knowing the risks that that credit is bringing into the institution, and the credit risk that is in a conventional bank is faced totally by the bank's own equity. In a participation bank, because these credits are financed from the funds collected from the public and managed by the bank, and the rewards, the returns on those credits are shared with those depositors, the full risk is not borne just simply by the bank, but is shared with the public in general. So if the non-performing asset ratio goes up, for example, the full impact of that, the provisioning for that, is not totally into the equity of the bank, but is shared by the depositors by giving them lower returns. So that is an important issue which definitely has an impact on the regulatory side when looking into the capital requirements of participation banks, for example. The other issue is market risk, for example. As you know, interest rates, as they go up and down, have sometimes detrimental effects on the conventional banks. When interest rates fall down, banks make profits out of the treasury bonds that they hold. And because there's a maturity gap between deposits and the credit portfolio, they gain because the credit rates are still high, but the borrowing rates are low, and they gain from increasing the margins. We saw this after 2007, when after the crisis, the interest rates in the Turkish market came down. The conventional banks made huge profits. But participation banks, on the other side, they don't face this interest rate risk. What happened was the margins of participation banks were not much affected. We didn't have a boost in the profits. They didn't come down, but they didn't grow up too. The reason was when interest rates come down, conventional banks can easily reduce their deposit rates to match the market rates. But because participation banks are still distributing profits and returns from past investments of the credit portfolio, which still have higher returns, the returns on the deposits are still high for participation banks, which caused in 2008 and 2009 a huge inflow of deposits into the participation banks, mainly commercial deposits, which were previously parked in commercial banks, because the deposit rates were down in the conventional banks, but were still, the returns on the participation bank Mudarebe accounts were still high. Expecting higher returns, these commercial deposits flowed into the participation banking system, which in 2009 grew by 40% actually, which is a huge surge, not easily to manage also. The opposite occurs when interest rates go up, which is the case which Mr. Beyaz was actually talking about. Currently, the rates are rising, so banks are losing their profit. Their margins are dropping, and they lose on their treasury holdings. But for participation banks, again, the margins do not differ that much. But because we're still distributing the returns on past investments, the rates of return on our deposit holdings are obviously lower than the market, which again causes those fluctuations in the deposit market. Now, there are solutions to this, maybe to which the regulatory should maybe address in the future. Things like buffers for profits, so that you don't distribute all of the profits that you earn right away, but put them in a buffer to be used at a later stage when such a margin emerges between the market rates and the returns on the deposits, for example. So it is important to understand the nature of the workings of the participation banks vis-a-vis conventional banks to make the different kind of regulations for these participation banks. Will the participation banks be an alternative? Is there really a paradigm shift here? Well, it depends on the population too. We have heard good models in the past. So we're talking about sustainability. Now, sustainability depends on whether people believe in that, whether the population believes in that. It's not just the regulators, it's not just the bankers, but whether the population are actually thinking about consuming less today to be able to continue to consume tomorrow, or for their kids to continue to consume tomorrow. If that is not happening in the population, then it's not enough for the regulators or the policymakers to push this issue. It will take a long time for the population to accept that, come to that. We play this game together with the population. So, participation bank, because the depositors, unlike conventional banks, do not have fixed returns, it's about taking risk on the part of the depositors too. It is about accepting this throughout the whole population. If this happens, then participation banks could be a model, if not an alternative, a major complementary model within the financial system. And because of the reaction to the different risks and different market environments, I think it will be better for the macro policymakers to have conventional banks on one side reacting differently and participation banks on the other side reacting differently to the same changes in the environment, so that the financial system in general will be in a neutral position rather than totally falling into a chaos or totally boosting and having asset bubbles. So thank you.